Most traders use trend lines, but they draw them wrong or trade them without confirmation. In this video, you'll learn how to do it right. We'll break down a complete system for trading with trend lines, how to draw them effectively, how to spot high probability continuation and breakout setups, and how to confirm each trade with real price action and indicators like RSI and Stochastics. It's clear, it's structured, and it works when you follow the rules. First of all, what are trend lines? Trend lines are key levels that naturally form in a trending market. We draw them because when price approaches these levels, they often present multiple high-probability trading opportunities. In a trend line strategy, two main patterns can appear when price reaches a trend line. The first is the continuation pattern, formed when price bounces back in the direction of the trend after touching the trend line. The second is the breakout pattern, which forms when price breaks through the trend line, indicating a possible trend reversal. But keep in mind, a touch alone doesn't confirm a trend change. You still need to apply additional price action techniques to validate the setup, which I'll cover later in the video. Now let's walk through a simple and effective way to draw trend lines. Should you draw trend lines? A common question among beginners is, should trend lines connect to the wick, the candle's close, or the candle's body? The answer is, draw them wherever you can get the highest number of touches. Let me give you an example. In this chart, we identified a clear uptrend as price formed higher highs and higher lows. Since it's an uptrend, you'll want to draw your trend line below the price movement. Then, adjust the line to capture as many touches as possible. Notice that some points overlap the trend line and others don't touch it at all. And that's completely fine. Remember, a trend line should be treated as a general zone, similar to support and resistance. Now let's look at another example. Here, we identified a downtrend with price making lower highs and lower lows. Since it's a downtrend, you should place your trend line above the trend. Again, adjust it to capture as many touches as possible. And that's really all there is to it. So, now that you know how to draw trend lines effectively, it's time to dive into how to use them to identify high probability trade setups. Let's begin with the continuation pattern. This occurs when price bounces back in the trend's direction after touching a trend line. But remember, you shouldn't enter a trade just because price touches the line. You need other price action techniques to validate the setup. One useful method for confirming a continuation pattern is by drawing a mini trend line at the pullback. The next step is to wait for price to break out of the mini trend line. That's your confirmation. Once that happens, you take a buy position. Now let's look at another example. Here we identified a downtrend, so we draw our trend line above the price. As we review the current price action, we spot another possible continuation setup. To confirm it, draw a mini trend line along the pullback. Then, once price breaks through, you take a sell position. Now, another indicator that can help confirm a continuation pattern is the stochastics. Here's how the strategy works. In this chart, we identified an uptrend, so we draw our trend line below the price. As we examine the current price, we notice a possible continuation pattern forming as price touches the trend line. At the same time, the stochastics is sitting at the oversold level, so we use the stochastics to help confirm the setup by waiting for it to cross back inside the oversold zone. Once the pattern is confirmed, you take a buy position. Now let's look at another example. In this chart, we spotted a downtrend, so we place the trend line above the price action. As we analyze the current movement, we see another potential continuation pattern forming while stochastics is at overbought. In this case, we wait for confirmation by watching stochastics cross back inside the overbought zone. Once the pattern is confirmed, you take a sell position. Now, moving on to the second pattern, the breakout pattern. This setup appears when price breaks through a trend line, signaling a possible trend reversal. Again, you shouldn't take a trade just because price broke the line. That alone doesn't confirm a trend change. You still need further confirmation to avoid false signals. One reliable method is to look for signs of weakening momentum before the breakout occurs. Let me show you an example. In this chart, price is clearly in an uptrend, so we draw our trend line below the action. At first, price continues making higher highs, but then, in the most recent moves, price begins forming lower highs. This shift means buyers are losing strength, a classic sign of momentum loss. Then, price breaks through the trend line, confirming the reversal. At that point, it becomes a strong setup to take a sell position. Let's look at another example. Here we identified a downtrend, so we draw our trend line above the price. At first, prices were forming lower lows, but then suddenly began forming higher lows instead, signaling that the downward momentum was fading. Shortly after, price broke through the trend line, further confirming the trend shift. This setup presents a strong opportunity to take a buy position. Another form of price action you can use to confirm a breakout is spotting double rejections before the breakout occurs. Here's an example. In this chart, price was in an uptrend, consistently making higher highs. But as we observe the most recent action, price failed to break above the previous high and instead formed a double top. A clear rejection and a sign of momentum weakness. Then, price broke through the trend line, confirming the reversal. At that point, it becomes a strong opportunity to take a sell position. Let's look at another example. Once again, we identified a downtrend and drew a trend line above the price as it formed lower lows. Then we observed a similar double rejection pattern near the bottom, suggesting a strong support zone in that region. Shortly after, price broke through the trend line, confirming a reversal to the upside. This setup presents a solid opportunity to take a buy position. Now, another tool that can help validate a breakout setup is the RSI. But before using it, you'll need to make a few adjustments to the settings. Go into the indicator configuration and set both key levels to 50. With that change, you'll now see a single line centered in the middle of the chart. And the way we apply the RSI in this strategy is by only taking buy trades when RSI is above the 50 line and only taking sell trades when it's below the 50 line. Now, let's see how this works in practice. In this chart, we identified an uptrend, so we draw our trend line below the price. Then, price breaks below the trend line, suggesting a possible shift in direction. But take a look. The RSI is still holding above the 50 line. That means it's not time to enter a trade just yet. You'll need to wait for RSI to confirm the trend change by crossing below the 50 line. Once it does, that's your signal to take a sell position. In conclusion, trading with trend lines isn't just about drawing lines, it's about following structure with discipline. The rules are simple, the setups are clear, but most traders still get it wrong. Why? Because they skip confirmation, they chase price, they break their own rules. If you want to build consistency, it's not just about spotting setups, it's about sticking to your process. And that's the real challenge, execution without hesitation. So the next time you draw a trend line, remember, the edge isn't in the line, it's in how you trade around it. And few traders highlight this better than Francis Hunt, who explains why discipline begins long before you enter the trade.
You start putting 91% into your chart analysis and looking at it across intra-markets. Say you're looking at buying gold. How's the gold doing relative to the dollar? Is it the dollar? Have you looked at gold versus the euro? You're doing all this intra-market analysis, looking at all the patterns, drawing every pattern in the run-up, seeing where all the key levels are, seeing how it's interacted with all the key round numbers, looking at the volume, where's the volume been building up, looking at the volatility, seeing if your setup is potentially a downside setup and comparing it with other similars that you've taken. You're doing some of these things that only some of what I do before a trade. You do that 91%, you're going to be part of the 9% on balance most occasions. What actually happens is people spend most of the time being in the trade and hitting the trade and trading in and out, and very little of that is actually in the pre-trade preparation. And it's like anything, you know. People used to say about Kevin Peterson for his batting, you put an immense amount of time in the nets. And then they'd say, oh, he's a good batsman, look at him swinging the bat. And they'd forget about how much work has gone into it, you know, beforehand. You see him playing in the test match. That's a fraction of what he's been doing on the batting front.
But preparation alone isn't enough. Without discipline in execution and risk management, even the best setups fall apart, as shown in this real case from Alexander Elder.
He won 5 weeks in a row, but blew up his account in one bad trade. Why?
We have a weekly competition for the best pick of the week. And the guy who wins the best pick of the week writes a report, how I won my gold. So we have this group of elite traders who are competing for the best pick of the week. We have a guy who, since the beginning of this quarter, October, November, now the first week of December, won 5 golds. And he's being thrown out of the group at the end of this quarter. This is why the black line is his equity curve. So he starts from 0 at the beginning of the quarter. And right now, at the right edge of the screen, he is down 15%. There are 13 competitors. There are 13 elite level traders. And the guy beats everybody half the time. If we go to the website, and this is a Spike Trade website, then right at the front page is his report, how he traded last week, what indicators he used, and how he made a 7.64% profit in 1 week. And he's being thrown out because his equity is here. So what's wrong with this picture? How come? There's no risk management. This loss which he suffered last week, he wants to win. So he's gaming the system. He buys a $5 stock. The guy buys a cheap stock, so he's waiting for a big swing. Unfortunately, those cheap stocks, when they swing the opposite direction, they're just as bad the other way. So he is profitable early in the week, and on Friday, the stock is called to open lower. So he pulls his stop. He doesn't want to be hit on the stop. And the stock does open lower and continues to slide, and by the end of the day, he's down 20%. So what is it? Lack of knowledge? Lack of understanding? It's lack of risk management.
Discipline isn't a trait, it's a process. And that process starts before the trade, continues during execution, and only works when it's consistent. If you're serious about building consistency, confidence, and control into your trading, the Psychology of Trading playlist is your next step. It's where the real work begins, the part no one sees, but every pro relies on. Because in trading, what happens behind the scenes isn't just important, it's what makes the difference. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro Trader community right here on YouTube.